now live. Just going to give it a second while people join, and then we'll go ahead and get started. All right, be mindful of time here. I'm sure people will continue to fill in over the first minute or so. Just make sure we are recording. Great. All right, we will go ahead and get started. Good afternoon, everyone, and welcome. Thank you for joining us for our Q1 2026 financial markets and portfolio update. Before we get started, I just want to note that we are recording today's session, and you are welcome to submit questions at any time using the Q&A feature, and we'll address as many as we can at the end of the discussion. I'm pleased to be joined here today by Steve Galley, our Chief Investment Officer, who will walk us through the market activity and what he and the advisors are watching. These market updates are always very informative, and Steve does a great job giving a comprehensive update. So, Steve, with that, I know there's a lot to cover as always, and I will turn it over to you.
Thank you, as always, Katie, and thank you all for joining today. Let's get into it. As usual, we're going to cover, what's going on out there in terms of market headlines, what matters, what doesn't. Talk about the bulls versus the bears. What their arguments are, how strong are those arguments, and then we'll also be discussing what we therefore are doing and adjusting with the portfolios. And at the end, we will have some Q&A. So I hope everyone's doing well as we're getting into the heart of tax season here, as well as a pretty cold winter in the Northeast. So all the headlines that we're looking at have happened pretty recently. This was a big one from the Journal talking about how our economy may have stuck the soft landing, to use gymnastics terminology. We'll talk a little bit about what the economy is doing and whether that's true. And of course, there's been always tons of headlines about artificial intelligence. And it seems though it's a constant litany of headlines about how AI is reinventing a lot of industries and making it seem like there will be several companies that are going to be hurt by the proliferation of AI and AI replacing a lot of what they do. So that's been an interesting development. So we'll talk about that as well. But if we take it a step back and just kind of look at what the bulls out there are saying and the bears, I think the bulls have a pretty strong argument. They're talking about how the economy is doing well. As a matter of fact, it looks like, the fourth quarter economic growth rate will be well above 3%. That will put the entire year of 2025 probably around a 2.7% growth rate, which was higher than anyone expected, and certainly comfortably above the long-term trend of around 2% a year. So the economy is strong, and the bulls are talking about how it's going to be even better in 2026 because we have a lot of stimulus thanks to the One Big Beautiful Bill Act, which will provide a lot of impetus for companies to grow faster. Even though stocks are expensive, the bulls say that's okay because that's justifiable because earnings are coming in higher than anyone thought they would. And a lot of that has to do with productivity gains thanks to, artificial intelligence. There also is a strong bull argument that even though the market is expensive, there is still a lot of cash on the sidelines. And we'll talk a little bit more about that. But money market fund assets, which is kind of a cash equivalent, are at record highs. So what the bulls are saying is even if we do have a pullback, all that cash on the sidelines will come pouring in when there's a dip. Now, on the other hand, bears are saying that maybe things aren't so rosy. We really don't know what the impact of AI will be. I thought it was interesting how a bunch of bears are talking about maybe it'll be a lot like electricity. When electricity was invented, it made a lot of firms a lot more efficient, but it didn't necessarily make them more profitable. because if all firms had access to the same innovation, then no firm is that much better than the other. Bears are also concerned about how a lot of stocks and bonds, quite frankly, are priced to perfection. So any negative surprise will cause a painful pullback. And the bears are also pointing out about how the consumer, while the numbers seem pretty good, it seems as though the consumer health might be weakening a bit. And they point to a slowing and small personal savings rate, which is a lot lower than it was, 6 or 7 years ago. Actually, less than half of what it was 6 or 7 years ago. And that's a problem since 2/3 of our economy is driven by consumer spending. So I do think there's legitimate arguments on both sides. So it's really a question of, who do we believe is correct? So when we talk about AI, I think the big question is, what is the magnitude of this new technology? What is going to be the size of the impact? And that's really the big question, because we know it's going to have an impact. It's really just a question of, is it going to be as big as a lot of the bulls think, or will it maybe be a little more chaotic and unpredictable, which is what the bears are saying. But I think it's interesting that, when you look at the history of productivity booms as a result of big technological innovations, and this is showing what happened when we first had personal computers appear on the scene, when the internet started to take off, and now with AI adoption, you could make an argument that we are actually in the early stages of what could be a pretty significant productivity boom. And by the way, a lot of pundits out there are saying that this AI technological revolution will be even bigger than PCs or the internet revolution. So that, I think, puts a bit of a feather in the cap of the bulls, saying that that is really going to be a powerful thing for company earnings moving forward. And of course, what are we buying when we buy stocks? We're buying the future earnings potential of companies. So, and there's clearly already significant impacts for certain sectors in terms of software development, robotic process automation, content management systems. And again, I think that's just going to expand in terms of the way companies will leverage this new technology. So let's also talk about what's happened year to date in the market so far. And I kind of sorted this by the year to date numbers just to give perspective, as well as showing the last 3 months, 12 months, and 3 years. So I think it is interesting that the market this year has sort of reassessed where they want to place their bets, where investors are placing their bets. So growth stocks, which in general are characterized by a lot of technology companies and communication services companies, they've actually been negative so far this year. What hasn't been negative are international stocks, and in particular, emerging market stocks, small cap stocks, and of course, bonds have been chugging away doing their job. And so what's really going on here is what I would call a bit of a rotation, meaning investors are shifting out of things that have been pretty expensive, growth tech, and into things that have been more reasonably valued, which are international stocks, which were smaller cap stocks versus large cap stocks. So that rotation that started to occur at the end of the fourth quarter last year, and it is continuing this year. I do think it's surprising that in less than 2 months, emerging markets are up almost 10% a year. A lot of that actually has to do with the fact that much of the infrastructure in terms of the build out for artificial intelligence, a lot of that comes from emerging markets. Taiwan is a good example. Taiwan is technically an emerging market. Taiwan Semiconductor is one of the biggest companies in the world. And we all know that that is an essential company in terms of supplying a lot of the tech that is being used for AI. So emerging markets have really benefited from the AI adoption trend, in addition to the fact that the dollar has been weak. And that's a great tailwind for international stocks in general. So this is where we were a year ago when we were doing this exact same presentation. And, a year ago, the forward price to earnings ratio of the S&P 500 was 22 times earnings, meaning for every dollar of earnings that you wanted to buy, you had to pay on average 22 times that dollar to own that particular stock or company on average. And here we are today, a year later, it's pretty close to the exact same spot, a little lower, 21 and a half. And you might say, well, the market's done really well in the last year. So how is it possible that the PE ratio is pretty much the same? That's because earnings have come in above expectation and have actually justified that premium that people are paying for that growth. So the ratio really hasn't moved because even though prices have gone up, so have the earnings in tandem. So that is why we are still arguably at lofty levels in terms of valuation. And again, if you look at, going back all the way to the mid 90s, the only time we're really in this area in terms of being expensive was during the dot-com bubble and briefly when we had a huge run up post the pandemic in the early part of this decade. So again, really what this is telling us is that stocks are expensive in terms of valuation metrics. Now, that doesn't mean that, we shouldn't be investing. I just think it means we need to be a little more careful and selective about where we are investing. And again, a lot of it comes down to earnings. And as people may have read, results from the fourth quarter, because we have almost all companies have almost reported their fourth quarter earnings. It's really shown a lot of strength. I think about 75% of all the companies in the S&P 500 have reported results, and in general, they have surprised to the upside. Now, that earnings surprise, the magnitude of the earnings surprise has declined a little bit from prior quarters, but the earnings results are still very strong. And this is from our friends at Goldman Sachs here. They're expected to continue to be strong as we progress. So that's really what we're paying for, future earnings growth. Now, the real question is, look at the earnings in terms of the PE ratio valuations versus history. Again, tech, we are in very rarefied territory. So what is this really showing us? The line represents the full range over the last 20 years of where these particular stock indices have been valued. And so the NASDAQ, which represents a lot of the tech companies in the United States, it's ranged everywhere from around 13 or 14 times earnings all the way past 30. The blue box represents where it would be about 2/3 of the time. And we are well above where we should be in terms of the averages. Not necessarily is true for small cap stocks as evidenced by the Russell 2000. That's actually at least within a reasonable range based on history. Again, that is why we've seen a rotation into small caps and why small caps so far this year have been very strong, because we've seen people go from what's very expensive to things that are not so expensive. Now, again, S&P 500, that's large cap, very expensive. Now, the equal weight, what does that mean? Well, equal weight is really when you say if every company in the S&P 500 is at the same percentage in an index, that's showing us that all the other companies besides the big ones are actually a little more reasonably valued. That is why we've seen a rotation from the big tech companies into some of the smaller ones that are more reasonably valued. So I think it's interesting to take a look at that because it does kind of play out in terms of why we've seen the rotation we've seen. This also is very clear why there's been a big push into international equity. The US is simply more expensive. After the global financial crisis, the price to earnings ratio for US equity is actually very similar to that of the rest of the world if we go back here. But now, because of the surge in big tech company valuations, it has pushed much, much higher than normal. Probably can't sustain that. And again, another tailwind for international stocks is the dollar. So this is showing us on the left the interest rate differentials between US and international 2-year interest rates. What that is telling us is when that interest rate differential gets smaller, our currency is less attractive. On the right, what I think is really interesting, as evidenced by the blue lines charting the trend, is that if you go all the way back to 1970, the dollar goes through very long cycles of either outperformance versus other currencies or underperformance versus other currencies. We had been in an incredibly long cycle of outperformance where the dollar was strong. Ever since the great financial crisis, the dollar had been strong against almost all other global currencies until pretty much the end of 2022, where now we've seen a gradual weakening of the dollar. Is that the start of another long-term trend? And a lot of the currency watchers out there are saying, yes, we're in the early innings of what could be considered dollar underperformance, which is another argument as to why there's been a rotation into international stocks, because they do benefit when we have dollar weakness. Remember, one of the things the bulls are pounding the table on is that there's a lot of money on the sidelines. So, and if you look at this chart, and by the way, the gray areas show when we had a recession, there's a lot of money now in money market funds. I mean, not even close in terms of how much is in money market funds compared to the last, 15 years or so. We have over $8 trillion sitting in money market funds. That's a lot of money on the sidelines that can be invested into other things if other things become more attractive. So that does give both the bulls and myself, quite frankly, a lot of comfort that even if we do see a pullback in the market, there will be a lot of cash that can be invested to mitigate a dip. And that is what's been happening, the buy the dip. So this actually is a chart of the S&P 500 for the last 12 months. So as you can see, we actually had a bit of a scare. I don't know if anyone remembers in 2025, pretty much at the end of the first quarter going into the second quarter, where we basically almost had a 20% drop. But the dip buyers came in, and 2025 ended up not only recovering from that drop, but then finishing the year strong with double-digit returns for the S&P 500. And so far this year, if you look at when we started at the end of the fourth quarter of last year, we had a bit of a dip. The buyers came in. At the beginning of this year, we've had a few dips. The buyers have come in. So it seems as though that argument that the cash on the sidelines will mitigate declines is playing out a bit when you look at how every time it seems like things are maybe a little scary, the buyers come in thanks to all that cash. I do want to mention, though, that if you look at going back all the way to 1995, and this kind of shows 5-year blocks, like what happened between 95 and 2000, between 2000 and 2005, etc. The last 5 years have really been unparalleled. It's simply amazing. We have had an incredible run in the last 5 years compared to any other 5-year grouping since 1995. And I do think it's important for investors to realize that that is not typical. This massive jump in the last 5 years is highly unlikely to be repeated. So I do think that, and one of the things we've been talking to clients a lot about is let's temper our expectations for returns moving forward. First of all, be very thankful that we've had such strong returns in the last 5 years. But again, I do think we need to be more realistic that is less likely that that will continue and that we will have another 5 years like we've just had, just given the magnitude of that growth. Now, thanks to one of our viewers and listeners out there, Kathy, and Kathy, I hope you're listening now. They did ask an excellent question about, what is going on with what's known as index concentration when you have a very small number of companies that make up a huge portion of the index, and how does that impact investing? And doesn't that make index investing dangerous because then you're really overexposed to those small group of companies? And this actually shows stats for the last 40 years or so. And it does show that right now, the top 10 companies in the index have an incredibly large effect on the index. The only comfort to that is that those same companies also have earnings that justify that huge outsized impact on the index. So to some extent, is it a bad thing when you have index concentration? Yes, because if something negative happens to a small group of companies, that can have a big impact on the index. But those companies' earnings have been strong and are expected to continue to be strong over time. So the other thing that gets into, though, is some of the ways that we invest in the market. And there are different ways to invest where you can invest in certain things that are equal weighted, which would de-emphasize those big companies, or you can invest in things that are market cap weighted, which actually doesn't de-emphasize those large companies. And so we do a combination of that and try and balance that out. So I'll get more into that in a minute. But yes, the index concentration is a little bit disconcerting, especially since it's higher now than really it's been in quite a long time. So, again, a lot of what company success will be driven not just by themselves, but also by what is the macroeconomic environment that they're operating in. And so this actually shows, except for the little dip we had in the first quarter of 2025, which was really induced by some of the tariff kerfuffle we had early in the year, economic growth has really been pretty good. And as you can see, the trend for economic growth over the last 24 years or so has been 2.3% a year. And as I mentioned, 2025 looks like it's on track to be well above that. And the forecasts are that 2026 is going to be just as strong. And there are really three strong tailwinds to the economic growth over the coming quarters. We have massive AI infrastructure build out. So all that spending that's already been committed to spend a lot in 2026 is going to be, juicing the economy. There is actually strong political support for bringing back a lot of industrial production into this country, everything from semiconductors to pharmaceuticals to defense. That's good for the economy. And again, fiscal policy is going to be expansionary. According to the Congressional Budget Office, a lot of the fiscal stimulus this year should lift GDP growth by almost 1%. So the bottom line is it's kind of hard to be bearish on the U.S. economic outlook right now. So it's even possible that as the year evolves, the conversation may shift from talking about the Fed cutting rates to maybe the Fed having to hike because the economy is so strong. So good news for bulls about the economy. Also, in the bond market, the bond traders are telling us there's nothing to worry about. And so what we're seeing here on the left is that corporate credit spread, and a credit spread is basically if I buy a corporate bond, let's say I buy an IBM bond, right? Well, is IBM as safe as the US government? No. So corporate bonds are traded on spread, meaning if a 5-year US Treasury bond is trading at 3%, it's likely that the IBM bond, same 5-year bond, is trading at 3.5%. That 0.5% is the spread, which is the extra interest that I am going to be compensated with for taking on the credit risk of IBM, since the US government doesn't have credit risk because they have the power of taxation and technically, therefore, should never default. So the bottom line is credit spreads are really, really tight, or in other words, you're not getting much for taking on the credit risk of loaning money to big corporations. And when that happens, it's basically the bond trader saying, we see no risk of companies defaulting anytime soon. So really, the bond market is telling us things are looking pretty good. Unfortunately, that means that for the bond portion of portfolios, the overall interest rate you're getting is not as high as we might like. But because interest rates are at least at a reasonable level versus several years ago, you still can get a reasonable 4 to 5% return from a well-diversified bond portfolio. And again, the default rates are actually proving the bond traders right, because what's staggering to me, and by the way, up in the upper right here, it says default rates according to credit rating. Now, credit ratings, everything BBB minus and above is considered investment grade. Everything below BBB minus, a la double B, single B, or triple C, is considered junk bonds. But over the last 12 months, double B, which is really in junk territory, 0 defaults. That's incredible when we're talking about pretty risky bonds not defaulting at all over the last 12 months. And by the way, even over the last 25 years, the average default rate on double B bonds is still less than 1%. So, I do think that that's what the market is telling us, that they're not too worried about problems with companies paying their debts back. And again, I think that's justified by what we're talking about in terms of the economy. Now, I wanted to talk about exchange traded funds because many of you who are invested in our portfolios may have noticed, because we were doing all the trading this week, that we are essentially removing mutual funds from all our portfolios. So what does that mean? Well, let's go back in time. When mutual funds were first invented, it was revolutionary, because if you, as an individual investor, wanted to invest in a bunch of stocks, well, usually your only option was to actually buy all those individual stocks on your own. What the mutual fund allowed people to do was essentially invest some money, and you would invest in a basket of stocks. It could be a basket of stocks that a portfolio manager picked. It could be a basket of stocks based upon an index. But the bottom line was you didn't have to then buy, let's say, 20 or 30 individual stocks on your own. You could just buy one mutual fund, and your money would be instantly divided up among a whole group of companies. So, as time evolved, we developed exchange-traded funds. Exchange-traded funds are similar. Again, they're funds in the sense that they represent a basket of stocks or bonds that you can invest in. The difference is that exchange-traded funds can be traded during the day. Mutual funds can't. Mutual funds can only be bought or sold at the end of the day. ETFs are also much more tax efficient. Because of that, the growth of the ETF market has been almost exponential. And that has come at the expense of mutual funds. So 20 years ago, and we can see by the growth here, 20 years ago, ETFs, or exchange-traded funds, barely existed. 10 years ago, they had, give or take, about $2 trillion. Now, the exchange-traded fund market, 14 trillion and growing. That's a 600% increase in the last 10 years or so. So, one of the reasons why we're moving into these vehicles is because A, they're more tax efficient, but B, if I'm a really good portfolio manager, I actually want to be managing a fund where assets are flowing in versus where assets are flowing out. So I do think it makes sense for us to really make sure that we are taking advantage of this trend and investing accordingly. Now, the other thing I want to mention is that as this market evolves, there are really three types of exchange traded funds. There are passive ETFs. And what does that mean? Well, similar to an index mutual fund, a passive ETF invests in an index, and therefore you should basically expect to get that index's return. So if, for example, you have an ETF that is based upon the S&P 500 index, if you invest in that ETF and the S&P 500 index returns 10% in a year, you pretty much should get about a 10% return, less a minuscule little fee. So that's very transparent, very clear, easy to understand. There are also strategic, or what are known as smart beta ETFs. That's another category. What is that? Well, it's similar to an index ETF, except there's an extra rule or rules on top of it. Meaning, let's say it's a S&P value-oriented ETF. That means that there's a rule that says, well, our universe of companies is the S&P 500, but we're going to screen out any company that has a certain metric that makes it look really expensive. So similar to an ETF based on an index, but it has an extra overlay of sort of a bit of a strategy to try and isolate a particular variable that someone thinks is important. But what's really been growing is what are now known as active ETFs. As the name sounds, active means there actually is a team or someone who are actively picking the investments and making choices for that particular ETF. And that's been a real innovation that wasn't really possible to be active several years ago, but now it is. And now active ETFs are growing really rapidly because you're getting the benefits of active management in a very efficient investment vehicle. And so that is why, if you all notice, that is why mutual funds will be, if they haven't already been eliminated from your portfolio, they will be soon. Now, that's not to say that mutual funds are bad. It just means that we are pivoting to what we think is even more efficient and optimal to execute your respective investment strategy. And again, just to emphasize, this shows the statistics on capital gains that are generated by particular investment vehicles. Now, obviously, this is more relevant to non-retirement accounts where taxes can have an impact. But if at the end of the day, what's really clear, and by the way, the bright green bar represents active mutual funds, you can see how much higher the cap gains are in mutual funds compared to ETFs. There's really no comparison. Because of the way ETFs are constructed, the way that they can avoid generating a lot of capital gains because of the way they're traded intraday, an advantage mutual funds simply don't have. So the tax efficiency angle is another reason why we think it is incredibly important to emphasize ETFs over mutual funds moving forward. So hopefully that's clear. And therefore, what does that mean we're doing this quarter and beyond? Well, first of all, when we did lean more defensive and into things that were a little more reasonably valued, that's paid off. Because as we saw that rotation that's happening from things that are expensive into things that are less expensive, that's benefited our portfolios. And we also will continue to favor international versus US, meaning having a bit of an overweight towards international for that very same reason that is more reasonably valued. We have potentially dollar weakness as a tailwind. And again, emerging markets are a very important cog in the AI production wheel. We will be either neutral or slightly underweight to fixed income, again, mainly because those credit spreads are tight. We're not getting as much bang for our buck when we're taking credit risk as we might like. But bonds are still playing an important role as a diversifier in portfolios. And while we do appreciate a lot of those bullish arguments, which are quite strong, we still think that some skepticism is in order. And so that's kind of the environment we're in. The market is very sensitive if things aren't coming in above expectations. So I do think that the market is kind of on a hair trigger for bad news. So as I was mentioning, we're in the thick of tax season. So I wanted to reiterate a couple of things that we're talking to clients a lot about. We've had an incredible run the last 5 years. Make sure that the portfolios are being rebalanced, even if that means you may recognize some gains. It's always better to recognize some gains and pay some tax than to see those gains evaporate because we have a bad market and those gains disappear. I also think it's important to really consider IRA to Roth IRA conversions, especially if your tax bracket makes sense to do that. Because really the bet is, do we think taxes are going to go up over time? Probably yes. Therefore, the Roth is the most powerful investment vehicle out there. And again, I do think it's important, especially when we're helping clients model out their future spending and financial planning. We do have to temper our expectations in terms of the future returns that we will get from the markets. I can't really fathom that we will have another amazing 5 years like we just had. I'm not saying we're going to have a terrible 5 years coming forward, but I do think the returns will be a lot more back to more reasonable averages, not necessarily double digits, ideally, and hopefully more single digits on average moving forward. So with that, are there any questions out there?
Great, thank you, Steve. Very informative and insightful as always. The only question we have, unless anyone else has one, was a quick one for you, which is what is going on with Bitcoin? What can you tell us the latest on Bitcoin?
Yes, the inevitable cryptocurrency question. I do think that, and there's been a ton of volatility in Bitcoin lately, as people have probably noticed, and also it's pulled back quite a bit. I would say the one really interesting observation about Bitcoin in particular is that it acts a lot like growthy technology stocks. There seems to so far be a pretty strong correlation when technology companies pull back or get into hot water, so does Bitcoin. So in essence, Bitcoin acts a lot like growthy tech stocks. That's what the trends have been showing us, at least on the limited trend information that we have. So be aware if you are, dabbling in cryptocurrency that you probably are therefore increasing your exposure to things like expensive growth technology type stocks, because that's the way Bitcoin seems to act. It does seem to track those types of companies. So it's maybe not so much of a diversifier as people would hope.
Great. Makes sense. Thank you. Looks like that was our only question for today. With that, I just want to thank you, Steve. Thank you, everyone, for joining us. Our next webinar, the quarterly, will be in May, I believe. Yeah, Q2. So we will send out the information for that. Again, we were recording today, so we will send out today's session to everybody. So thanks again. And Steve, any closing remarks before we go?
No, thank you all for listening, and we love your questions. And we always want to get better, so feel free to send us as much feedback. And I hope everyone gets through this winter and then can look forward to spring.
Exactly. All right, everyone, have a great day. Thank you. Bye-bye.